MPW Medical Properties Trust. What a bombshell. Is this trying to catch a falling knife, or does this represent deep value opportunity? It's trading at an amazing price to adjusted funds from operations ratio. Is this a buy? Are they simply throwing good money away after bad? Stick with me to the end of the video. We're going to look at exactly what's been happening, what's been going on with the stock, what's seen a huge decrease in the market cap for this company, but also, perhaps more importantly, what this means going forward and whether or not this is a company that is facing an existential crisis or whether or not this is deep value indeed. Let's get into it. This is big news. As we can see here, this is the news page on Seeking Alpha. Now, what we can see is it's dropping to the lowest levels of price since 2009. So we're talking about the depths of the global financial crisis, and we have surpassed those prices. Now, this is not a good nor a comfortable place for a company like this to be in. Now, what's going on? Well, it's plunged literally 1/3. So 1/3 of the company's market value has just dropped off. It's been eliminated. It's been wiped out. 1/3 of the value. Now, that is huge news. That's a big shift in the value of this company in a short period of time. Now, the big question is why? Why is a seemingly small event turning into this big issue for the company? So, what exactly has happened? Well, if we look here, the hospital landlord said it's granting another $60 million bridge loan to Stewart, and it's already $50 million behind in rent payments as the tenant is struggling with the liquidity issue. They're already behind. What do? We give them more money so they can get further behind. Now, this is a serious issue to me when I look at MPW. Now, the company's management has said previously that they wouldn't be throwing more good money after bad money. They made that promise on a previous earnings call quite clearly, quite explicitly. They wouldn't be throwing more money at Stewart, and yet here we are again seeing the management team go back on what they said they would do. Now, this is a very serious problem because that is a huge amount of money and it's putting them in greater and greater risk. Now, you say, look, this is a company. They can actually cover a lot of their requirements with cash flow. They've got a lot of funds still coming in. So, hey, why am I worried about this? Why do I think that they are now very, very close to approaching a very terminal situation? And now, if you flip this around, why has the smart money been pulling out of MPW? Why has 1/3 of the market cap been lost? Because of this. It's a small loan, $60 million. It's peanuts. What's going on? Why is this important? Let's get into it. Let's examine a little bit more about what's going on and what this means for the company and for investors today. Okay, we're the Medical Properties Trust page on Koifin. Now, there's a couple of really important points here to look at. Number one, short interest. Basically, 1/4 of the shares on issue being shorted, used for shorting. Now, this is up from a reasonable sort of 2% in the beginning of 2021, and we've basically just seen that continue to climb to a very high rate. Now, that's always a danger sign. It is, however, by itself, not a huge problem. Now, the issues that I see, we're getting down into some of the issues here. We've got a market cap of about 2 here, and we can see this market cap of 2 billion represents a substantial decrease in the market cap only several years ago. So this isn't a big issue. A market cap of 2 billion, total debt of over 10 billion. Now we can see that hasn't exactly gone anywhere. It hasn't been going down. It hasn't really been going up. But we've got some very serious issues here. We've got cash and inventory on hand of about 300 million, and the enterprise value here that is quite low as well. Now, some of the issues here, price to book 0.3 times. Now, that's suggesting there's something very serious going on here. We can see since these issues have started, the price to book has dropped precipitously. This is, in my mind, is suggesting that this is an organization in trouble. Now, as I switch over to the percentile ranks as well, there's a couple of key things here. Is this a falling knife? This could be representing deep value. We're talking about some incredible valuation multiples here in terms of their own 10-year history, in terms of other US and Canadian real estate, and even just in terms of general companies across USA and Canada. So we're talking some serious potentials here. in terms of, is this a falling knife or is this deep value? Now, the reason that I believe that it looks like deep value, and while I know that they've got some great cash flow coming in that they can use to cover their dividend, even though the dividend looks like it is at the moment, in fact, at quite a high and elevated level because of the precipitous price decline that we've just seen. My big concern is that this is disguising a very serious problem. Now, the problem in my mind is the debt. Yes, I know we talk about the debt. Now, look, when I teach in the business school, I'm often talking about risk management. Now, one of the most catastrophic things we can do is find ourselves in a situation of serious risk. When I teach in the business school, one of the areas that I really emphasize is risk and risk management. Now, by itself, yes, a little bit of debt is not a problem, and generally, this company has handled debt well. However, the challenge with debt is before very long, before you realize what happens, you can very quickly find yourself in debt beyond your ability to actually manage the debt until very, very quickly hit a tipping point where you get a very serious problem. Now, imagine, for instance, if you lent some money, your cousin comes to you to say, hey, look, Lincoln, can I borrow some money to buy a car? Now, I'm a fairly nice person. I like my cousins. I might lend them some money. Now, what do you think I'm going to think? And what would you think if your cousin then went away and they bought their car, just like they said, and they start paying you back? But then you hear, then you see that it's not just a car that they've been borrowing to buy, but you also see, their partner also now has a car. And in fact, they've also just bought a holiday home. And in fact, they've gone on a worldwide vacation. They can't afford that on their regular income. So what's going on? Well, it turns out they borrowed more money. How does that make you feel? If it was me that they borrowed the money from, I'd be very concerned. Now, the issue is I'd be very concerned that the money that they borrowed from me to buy that first car, I'm going to be very concerned that they're not going to be able to repay that money. Why? Well, they've borrowed all of this other money afterwards, and that's going to put them at risk of not being able to pay me back. Now, when you switch this around and you think about this from a corporate perspective, it works in very much the same way. When a company lends another organization like MPW, Medical Properties Trust, when a lender gives them the ability to use the money, the lender is also going to put in place some covenants or some security clauses and guarantees. They're going to say, hey, look, yes, you can borrow more money on top of the money you've already borrowed from us. We don't mind too much, but there is a point. There's a limit beyond which you are not able to go. If you go beyond this, that's where you hit problems. We will not allow you to go past that borrowing limit because that will represent too much risk for you as a company, MPW, and it's going to represent too much risk for us lending you that money. And this, my friends, is where I think MPW is at now. So let's have a look at some of the details now. So what do we have here? This is indeed for MPW. Now, all of these details are going to be a little bit different in every case. However, what we're going to find is there's very similar language and very similar terminology no matter which of these documents we look at. Now, here, for example, we have the 5% senior notes due in 2027. So that's only a couple of years away, right? What could be wrong? Well, the issue comes when we look at this section, the limitation on indebtedness. Now, the first issue here is the big one. And it's this first clause here. No, we're not lending you money. We're not going to allow you to go beyond an aggregated principal amount for the outstanding indebtedness of the issuer in the restricted subsidiaries greater than 60% of the consolidated total assets and issuers of the restricted subsidiaries. So basically, there's an upper limit there that MPW is not able to go beyond. Now, is that a problem? By itself, no, until MPW finds themselves in the situation that they are in now. Let's have a look at that. So when we begin to look at this price chart, we have seen that precipitous decline. We're also seeing the company itself trade at a terrible price to book ratio. Now approaching this limit of 60%. And by my calculations, I make it in the low 50s. So they're getting quite high. If they hit that point, what happens? And are they likely to hit that point? They can begin to issue shares they can increase the amount of equity. Now, is this a good time? It is a shocking time. If you're trading at 0.3 price to book ratio, if you've seen the share price drop like this, you are trading at a very undervalued level. This is not where you want to be. So this is a company, big decline in share prices, running up against their covenants with the people that have already lent the money. What are they going to do? Well, the simple solution is to issue more shares, horribly dilute anyone who has shares currently and survive. Or if they actually do hit that upper level of the covenant, Chapter 11. Good day, common equity. Goodbye, stockholders. So, what do you think? Is this a case of a falling knife, or is this a case of huge, deep value? My personal opinion is this is a company that appears to be going down, and I don't see the slide slowing down. In fact, I only see the problems now escalating. Debt maturities coming up in the next couple of years, looking very serious. A company that's looks like it's throwing good money after bad, lending more to Steward, one of the key tenants. What do you think? Hit me up in the comments down below. Personally, I know what I'm doing in the next week as I begin to exit all of the positions that I have related to MPW, and I'm going to see this company in the rear vision mirror because I don't want to say goodbye to all of the money invested there soon.